Hilton Worldwide Holdings NYSE HLT reported its Q1 2026 results on April 28, delivering a quarter that largely met Wall Street expectations. Investors were looking for signs of demand resilience, and by that standard, they weren't disappointed. The big question now is whether travel demand is starting to broaden beyond higher-income travelers, and whether that trend can last through 2026. The numbers provided a cautiously optimistic picture. Adjusted earnings per share of $2.01 beat expectations of $1.94, coming in higher than the prior year's reading of $1.72. Net income rose to $383 million from $300 million. Adjusted EBITDA climbed to $901 million, up from $795 million. System-wide RevPAR, the revenue per available room, grew 3.6% on a currency-neutral basis. The company also raised its full-year 2026 outlook. Full-year system-wide RevPAR growth is now projected at 2% to 3%. Full-year adjusted EBITDA guidance was set at $4.02 billion to $4.06 billion, and net income guidance was lifted to between $1.91 billion and $1.94 billion. The K2C economic shift, is it real and why it matters? Perhaps most importantly, CEO Christopher Nassetta addressed a shift in the broader economic narrative. The so-called K-shaped recovery, where upper-income consumers thrived while others struggled, appears to be broadening. On the earnings call, Nassetta described demand trends as increasingly resembling a C-shape, with more consumer segments participating in travel spending. Moving forward, investor sentiment about HLT's trajectory will depend on the belief in this widening demand base. The K-shaped economy describes a bifurcated recovery. High earners bounced back quickly after 2020, but lower and middle earners lagged behind. That has been evident in Hilton's results. Premium brands such as Waldorf Astoria and Cannes have performed well, while the company's budget and mid-scale brands saw softer demand by comparison. The shift toward a broader C-shaped recovery means more consumers are traveling. All Hilton brand tiers showed RevPAR gains in Q1. True by Hilton grew RevPAR 3.7%. Home 2 Suites gained 5%. Hampton by Hilton improved 2.6%. These budget-friendly brands serving everyday travelers were sluggish earlier in the cycle. If this demand broadening continues, Hilton's earnings power should increase. Over 8,200 of its 9,146 hotels are franchised, meaning Hilton earns fees with minimal capital risk. Franchise and licensing fees grew 11.4% year-over-year, YoY, to $696 million. Pipeline growth signals long-term confidence. Hilton's development pipeline reached a record 527,000 rooms across 3,768 hotels in 129 countries, which was a 5% increase from a year ago. During Q1, Hilton opened 131 hotels and added 16,300 rooms to its system. Net unit growth came in at 6.3% YoY. Management reiterated confidence in achieving 6% to 7% net unit growth for full year 2026. Nearly half of the pipeline rooms were under active construction, and more than half were located outside the United States, signaling strong international expansion momentum. Notable international openings included the Waldorf Astoria Rabat sale in Morocco and the Motto by Hilton in Brazil. New hotel deals included signing the first Motto in Australia and 2 LXR properties in Japan. This geographic diversification matters because it reduces dependence on any single market and captures growing international travel demand. On the capital return front, Hilton repurchased 2.7 million shares at an average of $301.71 per share, returning $860 million to shareholders in Q1 alone. Full-year 2026 capital return is projected at approximately $3.5 billion. Technical analysis, stock at a crossroads. Despite the positives coming out of the report, HLT is down more than 5% the day after earnings. However, this appears to be evidence of profit-taking after the stock's strong run since its May 2025 low near $230. The 50-day moving average at $312 is rising and offers a logical support zone on pullbacks. An RSI reading of 51 is neutral, reiterating that this drop in HLT is likely just profit-taking, not a sign of fundamental deterioration. Many investors have been uncomfortable with Hilton's valuation, which trades at a premium to itself and the sector. In that context, the retest of support at $312 isn't unusual or alarming in this context. Plus, it provides more upside to the consensus price target of $348.09. Risks to the growth story. There are risks that investors should weigh against the long-term growth case before sizing a position. For starters, the company is not immune to geopolitical concerns. Middle East RevPAR fell 1.7% in Q1, and management flagged the region as a continuing headwind into Q2. Hilton's $12.5 billion debt load also bears watching. Rising interest rates or tighter credit conditions could squeeze margins. Adding to investor concerns, the K2C demand shift is an encouraging trend, but it is not guaranteed.